Imagine trying to spot a massive, industry-defining company before the market for it even exists. You're essentially trying to predict the future of how humans will live, work, and consume. To do that successfully time and time again, you absolutely need more than just luck. You need a highly structured playbook. So let's dive right into the high-stakes world of venture capital, specifically looking at how one firm, Accel India, has consistently managed to turn total underdogs into global titans. Picture India in 2008. An ambitious startup named Flipkart is trying to get off the ground, but they're hitting a massive roadblock. Major institutional investors are passing on them left and right. Why? Because the country completely lacks the fundamental infrastructure required for e-commerce. Think about it. There are barely any reliable payment gateways. Consumer trust in online shopping is practically non-existent, and third-party logistics just don't exist at scale. How on earth do you build a digital retail empire in a landscape that practically rejects it? To survive, founders Sachin and Benny Bansal realized they had to bypass the existing system entirely. Originally, they actually wanted to build a price comparison site, but obviously you can't compare prices if no one is buying anything online. So they pivoted to selling books. It was a low-barrier entry point to get people comfortable with the internet. But what brilliantly illustrates their genius is how they tackled that massive infrastructure gap. They literally built out their own delivery networks from scratch and pioneered the cash-on-delivery model. This meant consumers didn't have to risk their money up front on a website they didn't trust yet. They only paid when the physical book was actually in their hands. Now, while other investors were looking at those systemic gaps and running the other way, Accel India was looking at the founders. They saw this relentless, uncompromising focus on the customer and a willingness to just get their hands dirty. Because of that profound conviction, Accel wrote Flipkart's very first institutional seed check. They believed in the founders' grit way more than they feared the market's limitations, taking a massive leap of faith. You know what's completely wild about this early journey? It's how they met their next major backer. A prominent global investor tried to reach out to Sachin Bansal via a cold email. But Sachin didn't recognize the name, assumed it was just spam, and completely ignored it, and went straight to the trash. The investor had to persistently chase them down through mutual connections until they finally met face-to-face in a chaotic, half-renovated apartment in Bangalore. It is amazing how unglamorous the origins of tech giants actually are. That initial seed bet by Accel was a monumental leap. They originally guessed Flipkart would need a substantial but modest amount of capital to break even. Well, they later admitted they were off by an absolute order of magnitude. But that core belief in the team paid off in a historic way. When Walmart eventually acquired a majority stake in the company in an unprecedented multi-billion-dollar buyout, it fundamentally reshaped the narrative of what was possible in the Indian startup ecosystem. So you might be wondering, who exactly was writing these early checks? Accel's real superpower in those early days was that their partners weren't just finance guys in suits. They were battle-tested operators themselves. They had been in the trenches, making payroll, writing code, and dealing with all the headaches of scaling a business. Tracing their evolution, it's a fascinating growth story. They actually started as a localized seed fund before morphing into a multi-stage powerhouse. Year after year, fund after fund, they scaled their ambitions parallel to the maturation of India's digital infrastructure. They weren't just riding the wave, they were actively funding the infrastructure that created the wave in the first place. Because partners like Subrata, Prashant, and Shekhar had literally built and scaled companies from scratch, they knew exactly how to spot gritty founders. When they looked at an entrepreneur, they weren't just looking at a fancy spreadsheet. They were looking for a reflection of that exact same builder's mentality they possessed. They understood the grind because they had lived it. That exact operator intuition is what led them straight to a fledgling company in Chennai that wanted to completely revolutionize clunky, terrible customer support experiences. They were building software as a service, delivering cloud-based apps directly to businesses. But what's incredibly endearing about Freshworks founder Girish Mathrubootham is that he had zero experience pitching to venture capitalists, none. He literally Googled standard pitch structures. He found a blog and followed their advice to put the team right on the very first slide. It is such a brilliant reminder that you don't need to know all the corporate jargon to build something incredible. You just need to know how to solve a real problem. Accel loved the vision and backed that team-focused pitch deck with a massive early seed investment. Freshworks then did something radical for the time. They bypassed traditional face-to-face enterprise sales entirely. Instead, they adopted a high-velocity digital-first strategy. Believe it or not, they acquired their very first customer 9,000 kilometers away, all the way in Australia, without ever leaving Chennai. They eventually evolved into a publicly traded global powerhouse, proving definitively that Indian software companies could dominate on the world stage. Now, as the ecosystem matured and global software was conquered, the most exciting challenges shifted back home to incredibly complex, highly localized logistics. Consumers wanted everything faster, better, and more convenient. Enter the founders of Swiggy. Originally, they started with a completely different concept, a courier and freight logistics service called Bundle. But they quickly realized the real massive opportunity was in the ridiculously difficult, operationally intensive space of hyperlocal food delivery. This wasn't just a logistical challenge, right? It was a deep engineering problem disguised as a delivery company. To truly understand the friction points of this huge pivot, co-founder Harsha Majety didn't just sit in an air-conditioned office looking at data dashboards. He hit the streets. He personally executed over 100 food deliveries himself to understand the operational grind, the traffic bottlenecks, and the restaurant delays. That is the ultimate example of being absolutely obsessed with the consumer experience. Accel recognized this uncompromising focus on owning the entire logistics chain. Swiggy wasn't outsourcing delivery. They were building an ironclad moat by controlling every single step of the consumer journey. That early backing led to a phenomenal outcome, ultimately generating an astronomical return during Swiggy's recent IPO. It cemented their status as a true cornerstone of India's convenience revolution. So, looking back at these massive wins, the crazy part is none of it was accidental. It wasn't just a lucky guessing game. They use a highly structured strategy called the Prepared Mind Playbook. They do intense primary research well in advance to develop a thesis on where technology is heading next. And because they do the homework early, they act as the very first institutional check the vast majority of the time. Once they're in, they don't just wait around for quarterly board meetings. They are incredibly hands-on, helping founders build their product, scale their organizations, and shape company culture. And that brings us to right now, the edge of a completely new frontier, applying this exact same prepared mind framework to the future. One of the biggest shifts we're seeing is obviously artificial intelligence. Through a programmatic framework they call Atoms, Accel is systematically addressing the massive global shortage of computer processing power and specialized engineering talent. They are giving early-stage Indian AI founders the exact tools and massive computing resources they need to build globally competitive, cutting-edge architectures right from day one, rather than forcing them to play catch-up with Silicon Valley. Currently, their thesis locking in on three massive pillars. First, enterprise AI. Think intelligent agents that actually do work for you, and smaller, highly specialized language models customized for businesses. Second, the rising consumer power of Bharat, targeting the massive, aspirational populations in Tier 2 Indian cities and Gen Z consumers. And finally, Industry 5.0. We're talking completely digitized, next-generation factory floors, tapping into the global shift toward diversified supply chains. With a massive new pool of fresh capital ready to be deployed into these complex new sectors, it really leaves you wondering. We've seen founders conquer e-commerce without logistics, build global software empires without ever leaving Chennai, and map the chaotic streets of India for food delivery. As we look at the incredible rise of AI and advanced manufacturing, what seemingly impossible barrier will the next underdog founder completely shatter? You know, the battleground for the Indian consumer market isn't just playing out in the cloud anymore. It is literally being fought on the streets. We're looking at a massive structural shift in how urban logistics are priced, scaled, and ultimately how they're monetized by Wall Street and institutional investors. When a massive private company finally steps into the glaring scrutiny of the public markets, well, the absolute underlying mechanics of its valuation are laid completely bare. So, let's get granular. We are tearing down the unit economics, the cash burn, and the absolute necessity of defending a physical moat against some pretty ruthless macro headwinds. To even justify stepping onto the public stage, you need a staggering operational footprint, and here it is. 2 million daily orders. Now, this isn't some theoretical software as a service projection on a spreadsheet. We are talking about 2 million real-world physical transactions executed every single day. Think about navigating the absolute chaos of urban traffic, unpredictable restaurant prep times, and of course, highly demanding consumers. That friction, that's the operational heartbeat here. It's the absolute baseline for literally every financial projection and margin strategy we're going to look at. And frankly, that massive operational density brings us directly to the magic number, a $1.35 billion public offering. But here's the thing, an offering of this magnitude isn't just a victory lap or a simple exit event for early venture backers. No, it is a structural necessity. It's the war chest required to fund the next phase of an incredibly capital-intensive battle. The public markets are essentially being asked to absorb this massive valuation based on one core premise, that the heavy infrastructure built over the last decade is going to yield dominant, monopolistic cash flows in the next. Which brings us to the ultimate billion-dollar question that institutional and retail investors are aggressively weighing right now. Can an inherently high-burn, logistics-heavy moat actually scale into sustainable public market profitability? See, private markets, driven by venture capital, they tolerate, and honestly, they even encourage extreme cash burn just to capture market share. But the public markets, they demand a clear, inevitable path to earnings per share. So the entire valuation hangs on whether this physical, street-level moat is deep enough to eventually stop the cash bleed and start generating real returns. Keep that question in the back of your mind. To understand how we got here, we have to look back to a defining strategic fork in the road around 2014. Back then, early competitors operated mostly as pure software aggregators. Basically, they'd list the restaurants and process the payments, but they'd leave the actual heavy lifting, the physical delivery, to the merchants themselves. The result? A wildly inconsistent, often frustrating consumer experience. So, a deliberate pivot was made to build an end-to-end, fully owned logistics network. Now, this meant absorbing absolutely brutal, heavy capital burn up front to control the entire delivery chain. It was a massive, calculated gamble. The bet was that owning the physical fleet was literally the only way to build an impenetrable moat. And actually executing that end-to-end model, that relies entirely on one thing: density. Right now, that density is supported by 220,000 restaurant partners. You see, when a platform owns the logistics, algorithmic routing only makes financial sense if there are enough nodes with any really tight geographic radius. If merchants are spread too far apart, your unit economics just completely collapse. So, integrating this massive network of merchants creates a powerful network effect. It's a web that is incredibly difficult for any new entrant to replicate unless they're willing to just set billions of dollars on fire. But merchant density is really only half of the equation. The network also requires immense human capital. Specifically, we're talking about an army of 450,000 active delivery partners powering this ecosystem on the ground. This fleet is the physical manifestation of all that algorithmic routing we just talked about. Yes, it represents an incredibly asset-heavy, management-intensive operating expense, no doubt about it. But it's exactly this massive, shared human fleet that locks in consumer reliance and effectively shuts the door on those pure software competitors. So the crucial focus for Wall Street right now is how all these moving parts actually interact financially to drive unit economics. It's almost like a giant puzzle. Food delivery acts as your base volume driver. It relies on that routing efficiency we mentioned, but let's be honest, it carries notoriously thin margins. So to counteract that, the model layers on cloud kitchens. This utilizes existing assets to drive margin expansion. And then finally, you have quick commerce through Instamart, which leverages ultra-fast dark store density as the hyper-growth vector. The whole financial logic here relies on the core, low-margin food delivery business, essentially subsidizing the fixed infrastructure you need to scale those higher-margin verticals. And the real pivot that makes all this viable? It's the shared fleet advantage. Think about it. By already maintaining a massive fleet of 450,000 delivery partners for peak meal times, like lunch and dinner, the platform can just utilize that exact same labor pool during off-peak hours for grocery delivery and local courier services. This is the moment where that initial painful capital expenditure actually starts to look like visionary infrastructure. Unlocking these high-margin market extensions is mathematically possible solely because the baseline logistics fleet is already paid for, essentially subsidized by the core food delivery business. This shared fleet leverage forms the bedrock of management's aggressively ambitious core earnings target, $1 billion for fiscal year 31. That is a massive number. Reaching $1 billion in core earnings requires absolute flawless execution, and it hinges almost entirely on scaling that quick commerce model. The core thesis here is that once the dark store infrastructure is fully depreciated and once consumer habituation is completely locked in, the margins on a 10-minute grocery delivery are going to significantly exceed the margins on a restaurant meal. It's a $1 billion bet, literally, on fundamentally shifting consumer behavior in urban India. Yet we have to be objective here. The structural risks threatening these long-term margins are severe. That extreme initial capital burn, it remains a constant nagging reality. And it creates a huge vulnerability to funding winters, which, by the way, is a macroeconomic headwind this platform barely survived back in late 2015. On top of that, you have a ruthless, high-density aggregator competition that is equally well-capitalized. If a rival decides to sacrifice their margins just to capture market share, it forces a localized price war, and that instantly degrades unit economics across the board for everyone. And let me tell you, the public market will not be nearly as forgiving of these macro headwinds as private venture capitalists were. Now, looking at the capitalization journey leading up to this IPO gives us a really crucial lens into institutional conviction. Back in 2015, venture firm Accel co-led what was a mere $2 million seed round based on a highly specific thesis about food delivery logistics. Fast forward to 2019, during an early secondary exit, backers realized a 12.2x return on portions of that initial risk, and that culminates today in this $1.35 billion public offering. This timeline is proof that early-stage tech underwriting, when you pair it with immense operational persistence, can actually weather harsh funding winters to reach ultimate public market scale. And when you look at the actual yield data, it reveals absolutely blockbuster venture returns. Accel invested roughly $75 million over the company's life cycle, but when you factor in those early liquidity events at a 12.2x multiple, the final IPO exit yield stands at an astounding 35x return on invested capital. 35x. Now, while this fundamentally validates the heavy risks taken by institutional funds in emerging markets, it also serves as a strict warning for retail investors analyzing the stock today. Why? Because the private markets have already extracted a massive premium. Future growth absolutely must be driven by pure fundamental earnings, not just venture-subsidized expansion. So as the dust finally settles on this $1.35 billion offering, the ultimate test begins. Will the public market's growing appetite for tech-led platforms actually sustain this valuation post-IPO? Retail and institutional investors who are now holding the equity are basically betting that this logistics moat is truly impenetrable and that aggressive expansion into quick commerce will actually deliver that billion-dollar earnings target. But if that capital burn flares up again to defend the empire against fierce rivals, well, will public shareholders have the patience to ride it out? The calculus has fundamentally changed and the market is watching.